Morning, and welcome to Chart Industries, Inc. fourth quarter and full year 2019's earnings call. All lines have been placed on mute to prevent background noise. After the speaker's remarks, there will be a question and answer session. The company's earnings release and supplemental presentation was issued earlier this morning. If you have not received the earnings release, you may access it by visiting Chart's IR website at www.ir.chartindustries.com. A telephone replay of today's broadcast will be available following the conclusion of the call until Thursday, February 20th, 2020. The replay dial-in information is included in the earnings release or on the company's IR website. Before we begin, the company would like to remind you that statements made during this call that are not historical, in fact, are forward-looking statements. Please refer to the information regarding forward-looking statements and risk factors, including in the company's earnings release and latest filings with the SEC. The company undertakes no obligation to update publicly or revise any forward-looking statement. I would now like to turn the conference over to Jill Evanko, Chart Industries CEO.
Thank you, Justin. Good morning, everyone, and thank you for joining us today to go through our current outlook for 2020 and 2019 results. Joining me today is John Bishop, our Chief Operating Officer, and Scott Merkel, our Chief Accounting Officer. You'll hear about the significant progress we have made in the past quarter, each aspect of the key drivers of our business for 2020 and the coming decade, as we walk through our supplemental presentation that was released this morning. These themes are shown in the strategy circle shown on slide 3, which you have seen both on last quarter's call as well as at our Investor Day in November. Today I'll start with our increased 2020 guidance, for which we have much higher conviction after the record order and backlog quarter to end 2019. As a reminder, we focus our guidance on the base business and provide color around what additional opportunities, in particular big LNG, exist that are not in the base outlook. Our revenue outlook is $1.645 billion to $1.71 billion, compared to the prior revenue outlook of $1.615 to $1.68 billion. The increase is driven from the timing shifts of fourth quarter 2019 orders and revenue related to 3 of the 4 segments. We have not revised our E&C FinFans revenue outlook from the prior quarter. Both guides are and were inclusive of $100 million of Calcasieu Pass related revenue. We expect full year adjusted earnings per diluted share to be in the range of $4.90 to $5.50 per share on approximately 36.1 million weighted average shares outstanding. This is an increase from our prior outlook of $4.75 to $5.25 per share, which was on approximately 35.8 million weighted average shares outstanding. Our 2020 tax rate is assumed at 20%. This is an improvement from our prior outlook's tax rate of 21%, driven by the strategic tax planning efforts completed in the fourth quarter of 2019. Our capital expenditure outlook remains between $35 and $40 million, inclusive of $30 million of maintenance CapEx and between $5 and $10 million related to our productivity and strategic capacity expansion activities, including the completion of our LNG vehicle tank line in Italy, supporting our 2 customers with sole source LTAs. This range is consistent with our 2019 actual CapEx of $36.2 million. Our free cash flow outlook is $180 million to $210 million, inclusive of approximately $30 million of free cash flow related to Calcasieu Pass. As we indicated in October and November, our 2020 outlook is weighted to the second half of the year for both revenue and earnings. Typically, the first quarter of the year is our lowest quarter, and we expect that will hold true in 2020. We anticipate the first quarter of 2020 will be at or slightly below the fourth quarter of 2019, not only from traditional seasonality within the year, but also from the negative impacts from the coronavirus, which we will explain today. Additionally, Calcasieu Pass revenue recognition will primarily be in the third and fourth quarter. As you can see on the far right-hand side of the page, there are additional big LNG opportunities that we have direct line of sight to booking in 2020. We have chosen not to include them in guidance as the timing is not specifically known yet, but we do have high confidence in them moving ahead to FID this year. You'll also hear about these today. Our 2020 increased guidance is the result of a very busy and noisy fourth quarter of 2019. Specific fourth quarter activities that increased our confidence in 2020 included continued optimization of our global footprint, cost structure, and margin expansion activities, combined with cost synergies from our recent acquisitions. The actions that we have completed as of December 31st, 2019, are expected to return over $38 million to the bottom line in 2020. Necessary ramping of resources for our E&C cryogenic big LNG projects and preparation for deliveries of our DNS East record backlog for trailers and fueling stations is another contributor. Many of you have asked about the availability of resources to ramp to the demand expected with big LNG, in particular given the low U.S. unemployment rates. We had the opportunity in the fourth quarter to bring back skilled former Chart team members and took advantage of that opportunity ahead of the exact timing of the demand. We added 18 additional heads in Q4 at our brazed aluminum heat exchanger facility in La Crosse and 29 at the cold box facility in New Iberia, Louisiana, with full year 2019 increases of 79 heads in New Iberia and 41 in La Crosse. While this cost burdened the fourth quarter, it keeps our 2020 delivery schedule on track. We also completed strategic tax planning work, which reduces our forecasted tax rate to 20%, as I previously mentioned. And we had timing of certain orders in the business, which reduced our fourth quarter sales, but bolsters our 2020 outlook. Specifically, LNG vehicle tank book and ship orders were less than expected in the fourth quarter, driven by a key customer changing design to a different liter-sized tank, and the receipt of over $120 million of orders in the last month of the year, which, while reducing the revenue able to be recognized in 2019, increases our 2020 guidance. And most impactful was the exceptional order activity, resulting in numerous records and record backlog levels. It's rare that we have multiple record orders in a quarter, and even rarer when we have multiple record orders in a year. We had this situation in both Q4 and the full year of 2019. Moving to slide 5. Fourth quarter orders of $344 million were a 20% increase over the third quarter of 2019. Perhaps most notable was that it was driven by 20% plus growth in 3 of our 4 segments, so a wide reach of strength. Also noteworthy is E&C Cryo's 55% sequential increase with no significant big LNG orders received. DNS West fourth quarter 2019 orders were the highest in the history of the business, with significant contributions from a variety of end markets, which we'll speak to shortly. And the fourth quarter contributed to a record order year for us, with full year orders of $1.413 billion, a 24% increase, and 11% organic increase over the full year of 2018. We also had full year record orders in trailers, LNG fueling stations, lasers, hydrogen, cannabis, and water treatment, as well as for our cryogenic equipment in India. Our VRV acquisition, which concluded its first full year in 2019 as part of the Chart family, expanded that geographic reach. Specifically, we had $16.2 million of synergy-related orders in 2019, with $5.8 million in the month of December alone. As I've said on numerous occasions, we love multiple orders in this range versus waiting on 1 or 2 big orders, and the fourth quarter took our prior quarter's record and blew it away. In the fourth quarter, we booked 37 orders greater than $1 million each, another record for us in this quarter. Of those, 12 orders were greater than $2 million each, 3 in each segment, so a nice balance of broad-based, consistent growth. So where are these orders coming from? Moving to slide 6, the 2 areas of our business that are driving above-market growth and will continue to do so in the coming years are the global clean energy infrastructure build-out and our specialty markets. Starting with the right-hand side of the slide, specialty markets has grown considerably in 2019, with record order levels in lasers, hydrogen, cannabis, and water treatment. We expect these product categories to increase above 10% in 2020, both in orders and revenues, and it's very possible that we could have a breakthrough year in both over-the-road trucking and hydrogen. For over-the-road trucking, our European LNG vehicle tank capacity expansion project will be in production in the second quarter of the year. Once ramped up, this will more than double our capacity to over $200 million of revenue throughput a year. This is well-timed, as our customers on sole source long-term agreements have indicated just a few weeks ago that they will be needing considerably more tanks than what is included in our 2020 outlook. Part of this is driven by the change to the newest tank model, which occurred in late fourth quarter 2019, and part is driven by the increasing movement to expedite cleaner fuel options in Europe. I will discuss the increasing hydrogen activity momentarily, but first, let me speak to our continued investment in these specialty applications and markets. We have dedicated R&D and new product development engineering teams who are working with multiple customers on confidential pilot programs. 7 new products for specialty market applications are in the pipeline for production release in the coming 12 months. The second aspect of our investment is our newly created commercial team dedicated to specialty markets. This team, which currently is comprised of 14 people, including commercial and engineering resources, will be significantly expanded to further penetrate the markets we have already described, as well as new market opportunities, including carbon capture, plant-based meats, or botanicals, as my team would correct me, and exploring other applications, including ones currently underway in customer pilot programs, such as liquefied biogas, renewable storage, and microscale LNG. Working with our emerging leaders, the team will also focus on taking specialty markets to the east from its existing base in DNS West. With the double-digit growth expected in 2020 and the additional market opportunities with existing products, we hope to have this turn into our fifth segment in 2021. Our second above-market growth driver is the global clean energy infrastructure build-out, which ranges from big LNG to small-scale LNG terminals, to transportation, whether by rail or road or ship, to the fueling stations and bunkering needed to accommodate the changing energy landscape. LNG fueling stations continue to be in high demand, with new record orders of 55 stations in 2019 compared to 30 in 2018. This is a steady increasing trend since 2017, where we had single-digit fueling stations. Under our MOU with AG&P, we have begun to contribute to the infrastructure build-out in India, including 5 related stations ordered at the end of December. Additionally, 2019 is our second consecutive year of record orders for trailers, with a nearly 10% increase over 2018. It's also important to note that this infrastructure build-out is truly global. At the end of 2018, we sold into 21 countries. At the end of 2019, we sold into 52 countries, and we are bidding on work now in 71 different countries. Even our China facility is seeing an increase in infrastructure order activity, mainly for export, with the fourth quarter being the highest order quarter in China since the third quarter of 2015. Finally, we received a $1.2 million engineering release order in December for one of our U.S. Gulf Coast big LNG projects. We consider this meaningful as it is a key step on an already won project that we have not yet booked as we await FID. This wasn't the only meaningful order in the fourth quarter, so flip to slide 7 to understand the impact on 2020 from our record order quarter. Not only did we receive the engineering release on one of the big LNG projects, we also saw broad-based order strength in the businesses. A quick comment on a few of these, starting on the left-hand side of the page. We received a $23 million order to supply our cryogenic PDH separation system in Canada. We booked a $21 million order for LNG by rail for a customer in Mexico in the last week of the year, which is our first significant locomotive order for our gas by rail products. In December, our VRV E&C team was awarded the $12 million DAXI order for 10 crystallizer vessels for a plant in China to provide polymers for applications like synthetic textile fiber and bottles. We booked a $9 million small-scale LNG equipment order for a facility in the Caribbean and over $5 million of LNG fueling stations with a key customer in Europe. Our MOU with AG&P is paying off with more orders for fueling stations in India. An application for hydrogen that we haven't spoken about previously is computer chips, and we received a $3 million related order in December for this application. We continue to collaborate with the Indian Space Research Organization, for which we received a $2.7 million order in the fourth quarter, supporting Modi's Make in India approach. And finally, while air coolers for the mid and upstream end markets began slowing in the second half of 2019, December order activity picked up, including the receipt of one order for $2.6 million. As we indicated in October, we took our FinFans 2020 revenue outlook down to the low end of what we thought would be possible for the year, indicating that we were in a wait-and-see mode relating to the mid and upstream customers' order activities through Q1 2020. And while FinFans is off to stronger than anticipated orders in January, with air exchangers having their highest order month in the past year, we are maintaining our prior outlook for this segment for 2020 at this time. Also in January, we received the LOI for Eagle's Jacksonville small-scale terminal, which includes our IPSMR process technology, a $2.3 million IOCL refinery order, 4 LNG fueling stations from a new customer, and multiple million-dollar trailer orders. Moving to slide 8, all of the fourth quarter activity contributed to our record backlog of $762 million, even when comparing with years where we had big LNG projects such as Wheatstone in backlog, at the same time as we had hundreds of millions of China LNG-related backlog. This record backlog is an increase of 34% from the fourth quarter of 2018. In our backlog are multiple orders that will help our customers achieve their ESG targets, in particular, the sustainability portion. As we shared with you at our Investor Day in November, we are focused on ESG, with 3 female directors out of our 8 board members, nearly 50% of our workforce being diverse, and a new internal ESG scorecard. Perhaps our biggest contribution to sustainability, though, is what we do for our customers' carbon reduction targets. So turning to slide 9, as I mentioned earlier, we are seeing increasing demand for liquid hydrogen storage tanks and other associated equipment, in particular for the development of SCEV stations in California and other regions of the world. After recently joining the Hydrogen Council, we see even further support for hydrogen as a clean energy source, and there is considerable public desire for knowledge around the safety, cost, and availability of hydrogen, which will be a key fuel at the Tokyo Olympics this summer. Hydrogen is expected to be a $2.5 trillion industry by 2015, and we are at the forefront of technology for liquid hydrogen. Our work on providing hydrogen components and solutions has directly helped our customers achieve their sustainability targets. While not naming specific customers, as many are developing additional carbon zero solutions with us, we design and build liquid hydrogen storage tanks for customers who integrate them into hydrogen fuel cell vehicle fueling stations for cars, buses, and forklifts. You can see some of the statistics around the cleanliness of hydrogen, including that while transportation accounts for 17% of global CO2 emissions, fuel cell vehicles have 0 tailpipe emissions. We are pleased with the continued education and increasing demand for liquid hydrogen equipment, which we expect to grow significantly in the next decade, as cost differentials between hydrogen and traditional fuels are reduced. Another example is our dosing offerings, where we are working with beverage customers to support their sustainability efforts. For example, certain large beverage customers recently have publicly stated that they are working to eliminate waste and lower their carbon footprint while maintaining customer satisfaction with customer-friendly bottle packaging. Through our liquid nitrogen dosing product solution, we are assisting these beverage customers in their efforts to reduce plastic bottle weight and utilize less plastic for transportation and storage. In addition to the strong above-market demand and customer ESG support, we see continued broad-based macro tailwinds in our markets, driven by the overall move toward a cleaner energy future. I won't walk you through each of these, as you've heard the global growth through our order and backlog activity, but 2 market drivers worth updating. The first, regulatory, specifically IMO 2020, which went into effect January 1st. It's clear that the demand is increasing for LNG as a marine fuel, and while we have not seen a direct impact from the regulation to date, and we do not have any IMO marine orders in our 2020 guide, we believe the activity will pick up as the year progresses. A year ago, we made investments into 2 marine-specific resources to build what we believe will be a growth platform in the next decade, as well as joining CLNG in the 4th quarter. We booked over $10 million of marine-related orders in the second half of 2019 and expect to build upon that in 2020. The second driver are government and country-specific moves toward cleaner energies. In 2019, global emissions were unchanged at 33 gigatons, even as the world economy expanded by nearly 3%. This is reflective of the increasing focus on the expanding role of renewables and alternative energy sources, as well as increasing focus at the country level. This list is extensive, with Scotland announcing the reduction to carbon emissions net zero by 2045, Spain targeting no coal in power plants by 2030, Germany determining that they will stop burning coal for electricity by 2038, etc., etc. For today, let's just talk about India, which recently indicated that they're planning a network of LNG fueling stations along their 6,000-kilometer Golden Quadrilateral highways. About 350 LNG fueling stations will be needed to cover that highway, and regulations only permit those with city gas distribution licenses to set up the stations. In addition to the stations, the plan also includes getting 10,000 LNG trucks. IOCL is one of these developers, and they're working with companies such as ExxonMobil India LNG, who signed an MOU in October with IOCL. As a reminder, we also have an LNG-oriented MOU with IOCL, so we expect to work closely with them, ExxonMobil, and others as the infrastructure continues to be built. Before we get to big LNG on slide 11, let's quickly touch on small-scale LNG. In our 2020 guidance, we have built in $50 million of small-scale LNG-related revenue. We already have multiple small-scale LNG-related equipment orders and the $9 million Caribbean project in our backlog. Therefore, just the Eagle LNG Jacksonville award alone, if FID occurs by early 2nd quarter, would achieve forecasted small-scale revenue in 2020. Big LNG is additional potential upside to 2020, as shown on page 11. We're well underway on the production of the brazed heat exchangers and associated cold boxes for Venture Global's Calcasieu Pass project, with $100 million of associated revenue included in our guidance. A few quick updates on the middle column projects, ones that we have high confidence in and expect to FID in 2020, which would trigger the booking of the orders for us. In no particular order, Tellurian continues to make consistent progress toward their 16.6 million ton per annum first phase of their driftwood facilities, with indications that the remaining 4 million tons needed to FID the 3 plants will be complete in the coming months, followed by completion of their credit arrangements. Recent news indicates that Tellurian and Petronet will complete their agreement in the coming weeks during the Modi-President Trump India visit. In addition to having all permits secured, in mid-December, FERC approved the driftwood site preparation work. Perhaps the best way to characterize our confidence level in driftwood moving ahead with FID and notice to proceed in 2020 is in the words of Meg Gentle, Tellurian CEO herself, just last month. Tellurian has already made the decision to go forward with this project. The only thing remaining is the incremental notice that is given at the end of financing. Cheniere's Corpus Christi Stage 3, 10 million ton per annum expansion project, received FERC approval in November and is expected to FID in 2020. With a total of 7 trains in Stage 3 and leveraging their shared infrastructure with Stages 1 and 2, we expect to receive notice to proceed on the project in 2020 for a total 7-train order size of just over $300 million, inclusive of air-cooled heat exchangers. Just this past Monday, the DOE approved Cheniere's Stage 3 non-FTA export authorizations. And the big oil companies, of which our IPSMR process technology has been validated by 4 of them, are making additional investments in both big LNG and small-scale LNG. During their earnings call, Total said they are making a massive bet on the low gas prices for the long term in the U.S., and others, such as Shell and ExxonMobil, are investing in the LNG global infrastructure with terminals, pipelines, and fueling stations. We are carefully watching the impacts from coronavirus, as there is concern around what China is doing in terms of their imports of LNG. Last week, CNOOC attempted to put into effect their force majeure clauses with Shell and Total, and both rejected them. Our 3 big LNG projects that are expected to move ahead in 2020 are not solely reliant on China offtake, as evidenced by Tellurian's expected completion of their agreement with Petronet. It's also important to note that United States LNG supply has had to rely on markets outside of China since the tariffs were put in place in September of 2018, and as a result, the direct impact to the U.S. supply is less impactful than places like Australia and Qatar that have contracted volumes to China. Speaking of China, we do have 3 manufacturing facilities in the country, so let me provide an update on the coronavirus situation for each of those. Our Chengdu facility, which produces cryobio aluminum tanks, was released by the government to return to gradual production beginning last Monday, February 10th. We lost 1 week of production, which is expected to be recouped within the first quarter. Our Changshu fans facility, which is midstream on their consolidation, returned to work on February 10th as well. This facility is in the process of being consolidated into other facilities and will close early in the second quarter of 2020. Our main facility in China is in Changzhou. Management applied on February 3rd for reopening per the government requirements and received approval to partially reopen beginning tomorrow, February 14th. The government has approved 32% of our workforce to return to work on Friday with certain restrictions. This will negatively impact our first quarter results, for which we have forecasted $18.5 million of revenue. The current situation, barring no further delays, is incorporated into our guidance that the first quarter 2020 revenue and adjusted earnings per share is expected to be at or slightly below the fourth quarter of 2019. We are supporting the efforts toward a cure of the virus, and this past week we donated cryobiological storage and transport tanks for research to the Wuhan Institute of Virology. Even with the coronavirus situation, we have continued to improve margin in China and other geographical cost structures. I'll now hand it over to JB to switch gears and discuss these margin expansion and acquisition integration activities on slide 12.
Thanks, Jill. As part of our margin expansion and integration activities, we continue to work to optimize our manufacturing footprint by determining where the best locations are to make our products, both from a cost and a lead time perspective, a theme you will hear from us throughout 2020. In 2019, we completed projects that will deliver $38.3 million of annualized cost savings from restructuring, footprint consolidations, operational improvements, product line rationalizations, and acquisition cost synergies. Included in this $38.3 million is $13.2 million of structural cost reductions and $25.1 million of acquisition-related synergies from VRB and AXC. We are expanding our 80/20 efforts to Europe and Asia, where we expect to realize similar benefits as we did in D&S West. Our global sourcing initiatives continue, with the most notable Q4 savings achieved by developing new suppliers and negotiating broader supply agreements to better leverage Chart's global scale and volumes. In the fourth quarter, We have put our primarily non-cryogenic valve product line, FEMA, based in Europe, in held for sale. FEMA is very small from a revenue impact, less than $5 million per year, and its products are not core to our cryogenic offering, and therefore we can better utilize the productive capacity for core products with high demand. This is an example of our continued evaluation of our portfolio to focus on where we bring the most strategic value to our customers. Turning to our acquisitions, while our official 12 months of integration is over for VRV, we will continue to have dedicated resources to execute on margin expansion initiatives like the standardization of tanks between our Czech Republic and Italian facilities, which is underway and expected to be complete by mid-year 2020. We have completed the insourcing of our inner and outer vessels into our Italian facility, saving cost as well as 10 days of lead time. We will not report any VRV integration costs in adjusted EPS in 2020, yet we will continue to report on cost and revenue synergy progress as we are extremely pleased with the progress to date, such as the 12 new customers and $16 million of revenue synergies from VRV in 2019. We continue to integrate the air exchangers business into our FinFan segment with anticipated cost synergies of $29 million annualized by June of 2020, of which projects targeting $20 million have been completed as of December 31st, 2019. The $20 million of projects completed in 2019 did not have much margin impact in the fourth quarter, but will immediately take effect in Q1 2020. Our overall integration efforts are combined with our global footprint optimization, and we've made the decision in Q4 to consolidate the China Changshu fans manufacturing facility operations into other existing fans operations, with the expected consolidation to be completed by the end of April 2020. This builds on the previously discussed plan to consolidate our China manufacturing footprint, which we mentioned earlier in the year when we eliminated 2 unprofitable product lines in China. The consolidation will not impact our ability to pursue our global strategic agenda, but focus our efforts on more profitable and productive operations. Additionally, in December, we signed an agreement to sell our former Chengzhou, China building, which has been consolidated in 2018. That sale is expected to close in the second quarter of 2020, at which time any gain on the sale would be recognized. Returning to other synergies from the air exchangers integration that were completed as of year-end or are underway. We have consolidated 3 Tulsa plants into 1. We are moving into phase 2 of our AXE integration, which is targeting overall E&C FinFan business improvement. This will include additional productivity enhancements, such as better utilization of our 50% owned joint venture in Mexico, increasing the supply of fabricated assemblies to sister plants. By better utilizing Mexico, we receive the benefit of low manufacturing prices and an increased dividend from our 50% ownership. One of the key strategic steps in our air exchangers integration is the movement of production to other geographic regions, including India. We already participate in both regasification and downstream infrastructure in India, such as LNG fueling stations, storage, and truck trailers. India is expected to have a 5-year compound annual growth rate of 15% for air-cooled heat exchangers. Therefore, we are expanding our FinFans manufacturing footprint to our existing manufacturing facility in Chennai, where we are assembling our first air-cooled heat exchangers by the end of Q1 2020. Additionally, we are expanding our existing presence in Hyderabad, India, which came from the air exchangers acquisition, to increase our global engineering resources to address growing project backlogs across all segments. To date, we have 40 engineers in Hyderabad, and we are targeting at least 20 additional hires in 2020, which have an advantage cost point relative to U.S. and European engineers. Now I'll hand it over to Scott, who will take you through slide 13 to discuss how these actions impact our financials going forward.
Thanks, John. In 2019, normalizing for acquisition price and a pro forma first 6 months of air exchangers, we generated $123 million of free cash flow, including unusual working capital activities in the first quarter of the year related to integration of VRV into our public company supplier payment practices. Also noteworthy is that cash from operating activities was $134 million in 2019, a 12% increase over 2018, driven by strict working capital management and the results from our 80/20 activities in D&S West, which reduced lead times in 27 of our 44 product lines. We expect free cash flow in 2020 to be between $180 and $210 million, including approximately $30 million from Calcasieu Pass. We continue to prioritize debt paydown and organic reinvestment in the business with the cash generated. At the end of 2019, our leverage ratio was 3.1, down from 3.3 post-close of the AXC acquisition. Our target at year-end 2020 is to be under 2.0. Sales of $342.4 million in the fourth quarter were 18% higher than the fourth quarter of 2018 and a 3.9% organic increase. Full-year sales of $461.7 million were a record for D&S West. E&C Cryo's fourth quarter sales of $58.9 million included $16.7 million of revenue related to the Calcasieu Pass project. Full-year sales of $1.3 billion is a 20% increase over 2018, representative of the continued order strength we saw throughout 2019. 2019 full-year sales were a record for Chart and an organic sales record as well, excluding VRV and air exchangers. Our aftermarket parts, service, and repair revenue continues to increase. It's currently at 13% for 2019 and is projected to incrementally increase with the expected 2020 activities of the industrial gas majors and the increasing opportunities of retrofitting brownfield LNG facilities that Jill referenced earlier. Gross margin and SG&A had many moving pieces in both Q4 and the full year, so it's important to understand the pieces to get a normalized figure as the jumping off point heading into 2020. Full-year normalized SG&A of $195.5 million is 15% of sales, compared to full-year 2018 normalized SG&A of $175.4 million, or 16.2% of sales. The 2020 SG&A run rate is expected to stay at 2019 normalized levels, even inclusive of the additional volume and big LNG included in our outlook. Reported gross margin as a percent of sales of 25.9% included one-time costs as previously described. When normalized for those costs, full-year 2019 gross margin as a percent of sales was 27.9% for the business, including E&C Cryo's normalized 19.2%, which included ramp-up costs for 2020 production that dragged on the margin profile in the second half and were not adjusted in the normalization. We expect Chart gross margins to be over 29% in 2020, resulting from the higher volumes in E&C Cryo, the savings already described from right-sizing the cost structure and acquisition integration, along with higher margin product mix in D&S West. On to slide 14. Fourth quarter reported earnings included cost associated with the continued air exchangers integration, the conclusion of our VRV integration costs, and cost-out actions and ramp-up activities as we head into 2020. Full-year 2019 adjusted earnings per share of $2.52 are an increase of 25% over 2018 and a record year for the business. The following adjustments are included. In row one relates to restructuring and transaction-related costs. These costs were associated with the organic cost-out actions taken throughout 2019, as well as the transaction costs for the air exchanger business. Row 2 is the integration costs associated with VRV and AXC integrations. As mentioned previously, with 1 year under our belt post-VRV acquisition, these costs will no longer be specifically called out. Row 3 is related to other one-time costs throughout the year, specifically related to our third quarter 2019 legal settlement. And finally, row 4 is a reduction to our adjusted earnings per share of 7 cents for tax affecting. I'll send it back to Jill to conclude our prepared remarks.
On slide 15, there were two noteworthy items in the fourth quarter. You can see what those are, and we included those in our press release. So I'd just comment that we pushed the volume into 2020 given the timing, as well as the adjusted EPS related to the ramp-up of our resourcing for both ENC Cryo as well as DNS East. Regarding thin fans, the fourth quarter also had under absorption, and in the second week of January, we reduced headcount by 137 people, anticipating similar volume levels in the first quarter. All of the above is included in our 2020 guidance. I'll now turn it over to the operator to open it up for questions.
Thank you. As a reminder, to ask a question, you will need to press star 1 on your telephone. To withdraw your question, press the pound key, and we ask that you limit yourself to one question and one follow-up. And our first question is going to come from Rob Brown from Lake Street Capital Markets. Your line is now open.
Morning, Joe.
Hey, Rob.
I just wanted to clarify your kind of color on the orders shifting out of Q4 into next year or 2020. I guess, could you reconcile how that $30 million flows in if Q1 is lower in terms of revenue? Does that flow in later in the year, or how does that $30 million kind of shift out?
Yeah, so there's a small portion of it that starts in March, which will be recognized, and that's about $3 to $4 million of it. We see the rest of that, so call it another $25 million, fairly evenly spread between Q2 and Q3, and that's a portion of that relates to the order for LNG by rail that I mentioned, which was $21 million. So a piece of that comes into 2020, and then the rest of that was around some of the LNG vehicle tank timing that I touched on.
Okay, good. And then maybe just the order kind of uptake that you're seeing. I think you mentioned a number of things already in 2020 that you've received, but maybe some kind of color on the overall order pipeline into 2020, I guess, in terms of LNG vehicle tanks in particular, and then maybe Eric's as well. You mentioned some things there, but just clarifying kind of the strength in the orders into this year and what you're seeing in terms of tailwinds.
Yeah, so January has started off fairly well for us in terms of the quarter. With respect to the LNG vehicle tanks, these are, in 2019, we had a full year revenue of $65 million. Our capacity right now, without the additional European capacity, is about $90 million out of our Georgia facility. We've been told, and until we have the purchase orders, this isn't guaranteed, but we've been told that these customers want as much as we can produce in 2020. So I'd anticipate that that ramps up fairly quickly here in late Q1 and into Q2. And I think it'll ramp even further once we start first production in April in Italy. So that has a lot of positive implications to us. We've built $72 million into our guide, so that gives you a sense of kind of where we have kind of down the fairway LNG vehicle tank. With respect to the other pipeline on the thin fan side of things, January started out pretty strong, and we had a total of $28 million in January in thin fans. 17.5 of that was air exchangers related. As I mentioned, the highest month since January of 2019, and certainly for total thin fans, that month has surpassed the prior 4. In terms of the other 3 segments, the base businesses continue to kind of tick along. I think there's a lot of opportunity in the East, certainly in the first half of the year, around continuing these record levels in fueling stations as well as trailers.
Okay, thank you. I'll turn it over.
Thanks, Rob.
Thank you. And our next question comes from Eric Stein from Craig-Hallum. Your line is now open.
Good morning.
Hey, good morning.
Maybe I will just start with kind of a high-level question, but just kind of what's going on in the market. I know the 3 big LNG awards that you're targeting in 2020, not necessarily impacted by this as much since they're kind of down the road, but just maybe the push and pull you're seeing in the market between the spot price of LNG and the forward curve, which is much more constructive for projects. How you see that impacting the business today, and then maybe as you look out a couple years.
Yeah, so I mean, certainly supply and demand have not crossed yet from an LNG perspective, and low natural gas prices and the lower LNG prices, as a general, are a headwind to some of these projects. what we see in particular to the projects that we call out for expectation for FID in 2020 is really around the thought process that these are 5 to 10 year type projects. So, the short-term macro situations, while maybe impact a quarter or two, as we've said before, whether it was tariffs, whether it was low natural gas prices, whether it's coronavirus, these guys are in it for the long haul. They have a lot of approvals, and our understanding is it's at the finish line in the first half of 2020.
Got it. Okay. And then I guess maybe last one for me, just on China. I think in your prepared remarks you just talked about that you were starting to see a little bit of an order uptick there. So maybe just outlook on that side, and realizing that coronavirus, that's kind of to be determined, although you're hopeful. But then should we also take the tax rate, and I know some of that is tax planning, but as part of that you expect China to be profitable in 2020?
So first, around the coronavirus situation, certainly what you read in the news is the same thing we're reading, so we're kind of taking that day by day, but you got a sense of the fact that we're back into at least partial production in all of our facilities. I'm very positive on the recent order intake in China, in particular the fact that the order intake is for exports from China into regions like Europe. So that's an interesting change in the last 6 months, and it's a positive from my perspective, both from an order standpoint, but also from a margin standpoint. Just by way of anecdote, we had planned for single-digit order intake in January, and we actually beat that even with the holiday and with the coronavirus in our China locations. So that's a good start to the year for us. We do anticipate a profitable year. Again, take profitable in China to be fairly low, so it's not break even, but that does help us, as you commented around our tax rate. We feel very good about our guided 20% tax rate, and while without giving anything more away, that could improve as we see the situation in China unfold.
Okay, thank you.
Thanks, Eric.
Thank you. And our next question comes from Ben Nolan from Stifel. Your line is now open.
Hey, team. So my first question relates to something that Scott mentioned, that the aftermarket was 13% in 2019. I believe that you guys had indicated that for 2021 you were looking for that to be 21% of the business. Does it still stand? I mean, is that target kind of still what you're looking to do, and any thoughts around that?
Yeah, that's still our target, and we have a pretty good line of sight on some incremental increases in the year 2020. I'll give you two of those. One is around committed volume levels in some of our major customer LTAs that are currently in the negotiation process, and some of those that we already have completed negotiation on, as those customers continue to refine their supply chain strategy as well as their optimization of their own assets that are in the field. The second line of sight that we have is around something that we didn't spend a lot of time on today, but we've touched on at least in the last couple of months, which is the opportunity for us to have retrofit potential on some of the projects for LNG export that are brownfield or existing that need to be optimized to keep up with the driving down of LNG pricing. So we did book in January a $1.2 million order in our FinFans business for a retrofit on an existing brownfield facility. So I think you'll see that incrementally move into the mid to high teens in 2020, given some of the additional activities that we have underway.
Perfect. And then for my follow-up, it's a little bit more industry related, but away from maybe some of the big LNG projects in the United States, there have been a number of big projects elsewhere in the world, in Russia and Mozambique, Nigeria, for instance, that have all gone FID, and I think it's very likely that Qatar will do the same in the next few months. Do you guys have any content in any of those, or is that something that incrementally to what's already on the books could be added as we look forward?
So they are potential incremental adds for us, and we would have content on many of those projects, more with respect to pre-treatment for brazed aluminum heat exchanger content versus the full liquefaction. Those projects tend to have been longer in the tooth, so they would have been baseload projects that had different equipment and different liquefaction process before our mid-scale IPSMR came out. So these projects for us would be content, ranging between $10 and $50 million, depending on the size and depending on the construct of the pretreatment facilities. Those aren't built into our guide.
Okay. All right. I appreciate it. Thanks a lot, Joe.
Thanks.
Thank you. And our next question comes from J.B. Lowe from Citi. Your line is now open.
Hey, morning, everyone.
Hey, JB.
I think you guys did a good job of kind of laying out, the timing differences between the revenue shortfall in 4Q moving into 2020. I'm just wondering, do you think that maybe 2020 should have a wider range of EPS guidance? I mean, what do you think you have more confidence going into 2020 that the business can be a little bit more stable? I know it's been lumpy in the past, but I'm just wondering what gives you confidence in the range, given some of the timing issues?
Yeah, I mean, part of it's philosophical, right? I mean, 3 or 4 years ago, you would have seen a range from 10 cents to $1, and it's kind of hard to really get a sense of the confidence level in a range such as that. In the current environment that we sit in, given what we talked about today on order and backlog and our understanding of the timing, coupling that with we know the earnings from Calcasieu, we know the impacts from the $38+ million of completed synergies and margin expansion. So we have a pretty darn tight bridge to walk from our 252 in 19 to our 490 to 550. So I think we would say, we give the range because there's variables that can impact the year. That's why the low and the high. But you won't see us expand the range beyond the 60 cents that we have in between 490 and 550.
Okay, thanks for the answer. Just a couple quick ones. The LNG tank capacity that you mentioned, the throughput of 200 million a year, are you actually going to hit that number in the back half?
I don't think we'll hit 200. So I think it'll be certainly better than the 72 and change that we have in our forecast right now. But that 200 would require everything to tick right out of the gate for a full year. And so I'd say it's probably better than the 72, but not at the 200.
I guess, are you going to hit the run rate, though, in the back half?
That will depend on whether these two sole source customers do what they are telling us they're going to do. If they do that, yes.
Okay. And then last quick one. If you were to get one of these other big LNG projects FID'd in 2020, when you start doing work on those projects, do you think you'd need to add additional headcount beyond the guys that you brought back for the Calcasieu Pass work?
Right now, we could take on one more with the guys we have in-house. If we get more than one, we'll have to continue to ramp up. One of the great things that happened kind of in our downturn in the cryo business is that in particular the La Crosse brazed aluminum facility did a lot of optimization of the footprint, but also around some of the robotics and the machining. So where at the last peak we had one big LNG project running through that shop, we had 470 people. With 3 big LNG projects running through that shop now, we'd probably be at about 350 total. So you'd ramp, another 50 to 70 heads if we got to this year in that facility.
Okay, great. Thanks.
Thanks.
Thank you. And our next question comes from Martin Malloy from Johnson Rice. Your line is now open.
Good morning.
Hey, Marty.
On the LNG infrastructure, and I guess including equipment for regas facilities, can you break out roughly what that was on a revenue basis in 19 and kind of maybe a range for where that might be in 2020, excluding the big LNG and the Gimme project?
Sure. So, we kind of break the regas from the small scale. So if you just take the small scale, as I commented, we have $50 million of small scale related revenue in 2020's guide. That's compared to 30 in 2019. If you look at the regas side of things, we had about the same equivalent in 2019, and in our 2020 forecast, it's basically the same as the small scale. So in totality, about $100 million related to those of revenue.
Okay. And then the rest of the LNG infrastructure in terms of the tanks and the fueling stations and everything else would fall into that infrastructure bucket.
It would, correct, yeah. So we just the way we think about it, we separate it that way. But if you lumped it all together, it's hundreds of millions.
Okay. Okay, great. And then just on the FinFan segment, quite a drop off from third quarter into fourth quarter. You mentioned that the orders were strong early this year. Could you maybe talk about your confidence in the outlook for that segment in 2020 and maybe some of the potential positives and negatives that might occur?
Yeah, so we slashed the guide on that segment back in October, and we did that purposely to take it to what we believed was, kind of the Armageddon scenario for 2020, so that we didn't have to come back around, sitting here today and do it again. And that's why we haven't raised anything from that 190 to 200 for the total segment, for the AXE part of the total segment for 2020. I would say right now where I sit, I would put it as cautious still. I wouldn't even say cautiously optimistic. I think January was a good month, but 1 month does not make a trend. I'll have a much better answer for you in what we see for the rest of the year once we see the February and March numbers come through.
Great. Thank you.
Thanks, Marty.
Thank you. And our next question comes from Walter Liptak from Seaport. Your line is now open.
Hi, thanks, and good morning. I wanted to ask about the funnel of projects in India. It sounds like things are going well there, and I wonder if you could help us understand the opportunity for that India highway project in terms, what's the size of it, and what do you expect this year, and then anything else in India that we should be thinking about that could build in the funnel as the year goes on.
Absolutely. We're very, very bullish on India across the board, and it's a combination of the things we talked about on the call, some things that we can't talk about that we're in confidential agreements under that we expect to progress this year, which could be pretty needle moving. Again, not built in the guide, but with some of the big oil companies that are starting to put footprints in India as well. As JB mentioned, we'll have our first air cooler that'll be assembled in India, so that opens a new market, which interestingly enough, the highest growth region for air coolers in all of the world is India, with a 15% plus CAGR forecasted between now and 2023 for growth on air coolers. So what I really like about the India opportunity is it's widespread across our business. So it hits DNS East, it hits E&C Cryo, and it hits E&C FinFan. And that gives us a lot of levers to pull. I also really like that it is a race for people to be involved, our customers, whether it's the big oil companies or the local IOCL, GAILs, AGMPs. So I would say the size for us, if they do 10,000 over-the-road vehicles, that's, you figure one vehicle for us is 2 tanks type of thing, and you'd probably get per vehicle $10,000 of content-ish. You can kind of figure out the math from there. So it's a pretty big potential. Again, we've built into our 2020 guide just an incremental increase of 7 to 8% over our 2019 numbers. So it could move quicker than what we're talking about here. And we're really excited, especially given the $6 million of orders in India in December, in the month of December alone. So we think that trend continues on.
Okay, great. And then just as a follow-up to the discussion you had about the meaningful orders, it looked like that was pretty broad-based. And excuse me, I wondered about pricing on those, engineering costs. What does the margin mix look like in the orders that you took in the quarter?
That would probably put me at a competitive disadvantage to answer that specifically. But the best way to think about it is that through our 80/20 process in particular in the DNS business, as well as the negotiations on our long-term agreements, these projects as well as the total backlog margin in backlog for us, we feel real confident in that 29% plus total chart gross margin that Merck mentioned in his prepared remarks.
Okay, great. Thank you.
Thank you. And our next question comes from Connor Lynagh from Morgan Stanley. Your line is now open.
Thanks. Morning.
Hey, Connor.
I was wondering if we could come back to FinFans a little bit here. It's good to hear the outlook is relatively unchanged. Could you just comment on how the shape of this, the guidance that you're expecting for 2020 looks relative to the first quarter that you're expecting? Just trying to get a feel for how front half versus back half weighted the expectations are.
Yeah, so the first quarter I would model very similar to the fourth quarter. Given the January order activity, you can ramp that up starting in April. So generally the FinFans business is kind of a book and ship of 12 to 20 weeks type of time frame. And so some of the orders that came in late January will start hitting in March from a revenue standpoint. And we see it going where Q1 and Q4 are the lowest quarters of the year, and Q2 and Q3 are the highest for FinFans in terms of shipments. The other thing maybe, Connor, worth noting is what we're hearing from the customers is that they expect summer to be the busiest period for them. So there's some orders and some ramping manufacturing-wise that's happening now so that they're prepared to take the equipment come end of May and June timing.
Got it. That's helpful. And then similar sort of nitpicky question. We've covered the interesting stuff. The E&C cryo business, just so we can get a base for 2019, how do you think, how much big LNG revenue did you actually end up earning in 2019? And then, I guess I'm wondering, what's the year-over-year step up, including Calcasieu, but net of some projects that are rolling off?
Yes, so we had $17 million of big LNG revenue in 2019, all Calcasieu related. And we have the $100 million in total built into 2020, all Calcasieu related. That's the only big LNG that's in our outlook.
Okay. And last one, if in fact some of these other big projects do come through, how should we think about the free cash flow impact of that? Is it a net positive because you get some early progress payments, or is it a net negative because you have to ramp working capital?
If any of them are net positive to us when we book them, so there's milestone payments, and then in particular the structure around some of the process technology is cash up front.
All right, perfect. Thanks for the color.
Thanks, Connor.
Thank you. And our next question comes from Greg Cherie from Tuhoy Brothers. Your line is now open. If your phone's on mute, could you please unmute it? Greg, your line is now open.
Hello?
Hey, Craig. We can hear you now.
Oh, I'm sorry. Craig Shear. Sorry.
Hey.
Two follow-ups here. Jill, you had some really positive comments in the Q&A about the opportunities for over-the-road trucking, also in India. But if I understand it correct, the $200 million run rate you talked about was potentially from two primary European customers. Is that correct?
That's correct.
So if those European customers do indeed take everything you can produce even after the upsizing, to meet the opportunities in India, you'd have to expand again?
Correct.
Okay, and in terms of cost and timing for that, how easy would it be? Is that something that could be started in the second half, and how much would you be looking to spend?
Sure. So we, with our India facility that came with our VRV acquisition, the great part of that is we own the land adjacent to the facility, so there's the ability to add a bay right on the existing land. We've done a lot of homework in the last 3 months around specific product lines that we might want to manufacture in India. Bishop talked a little bit about that, but we've really looked at it from a total global product line perspective, inclusive of what you're talking about. And in order to accommodate what we would want to do, it's a $5 to $6 million US investment, and we believe we could get it done in 6 to 8 months. We're not ready to pull that trigger yet, and we'll just keep an eye on some of the demand activity and what we're seeing from commitments in the region.
That sounds pretty quick and a nominal cost. What would that do to your run rate capacity?
It depends on the product line, but if you just took the over-the-road in particular, and obviously there's some design elements and there's some confidentiality elements around models, but let's just say we took kind of a down the fairway between the models that we have right now, we could probably add another $75 million US of capacity if we were to do a similar line to what we're doing in Italy. And it's probably worth noting that every line that we do that is for the same product, we get more and more efficient, and we lay things out better, and we're more thoughtful. And once you've done it once or twice, you start to get better, right? It's like the Outliers book.
That sounds terrific. And last question. I wonder if the opportunity for upsizing capacity on existing operating liquefaction facilities around the world is pushed out a little bit because of the 2020 oversupply, and whether it's pushed out or not, if you have any further color around the potential size of that opportunity over the next 2 to 3 years.
Craig, hey, it's John. Jill's talked in the past about what we think ultimately the retrofitting opportunity is. We actually think that in the low price environment, what you might actually see is more people looking to increase the efficiency of existing assets. And so we're actually seeing those conversations ramp up right now as opposed to go down from the level that we discussed earlier. So in a low price environment, we think those conversations could increase and potentially even adding to the number that we've given previously.
Do you think you could exceed what's baked into guidance in 2020 on that?
You always get us on this, Craig. You always get us. We think that we've given a very fair and achievable guide for 2020, and we've kind of talked very transparently about where there might be upside opportunities. But we'll stay with if we can double our EPS this coming year from last year, we feel pretty darn good about achieving that.
Fair enough. Thank you.
Thank you. And our next question comes from Anders Manekla from Evanko. Your line is open.
Hey, Jill. How are you? It's Andres. I'm just stepping in for James as he got pulled away to a meeting.
Hey, Andres. Great to hear from you.
Most of the questions have been answered already, but I do have one question about how we should think about working capital usage for this year. So you mentioned that you guys had pretty tight discipline in 2019, and I'm just trying to see how much of your $200 million free cash flow guide is depending on working capital efficiency, and what kind of leverage you can pull to keep that at similar levels, or if it's going to slip out a little bit this year based on the order book that you have going.
Yeah, working capital is right down the middle from our 2019, so there's nothing unusual in our forecast for it. We've actually accounted in the guide of 180 to 210 for some of the ramp up that we've talked about around some of these product lines in terms of inventory and ensuring that we don't create lead time challenges for our customers. So there's really nothing unusual in that outlook, and we feel really good about that, what we've put out there for 2020. And coming off of, $123 million in 2019, pro forma for what we talked about, with the $38 million of the cost savings that we talked about, combined with 30 from Calcasieu, combined with the organic growth rate, it's everybody around the table would say free cash is one of the metrics that we feel fantastic about heading into 2020.
Okay, great. Thank you for that. And then the next question I have is in regards to India. So no doubt the fundamentals in that country look good, especially from your guys' perspective. But I'm just trying to think of to what extent can that be consistently translated into profitable growth. So it seems like DNS East is kind of right-size itself in this profitability. So, what's your outlook for 2020 in terms of India just having, a better year in terms of margins?
Yeah, so we've built in, I would say, again, kind of down the middle around margin improvement in the East. The East is the most challenged around the fact that they should be in the high 20% gross margins, but it's many different pockets of having to handle different pricing structures like China, like India, some of the ramp-up costs that we've talked about. So if you really kind of look at the East and how we think about margin, we think about it fairly regionally, China being the worst out of the regions, India being kind of in the middle, and some of the efficiencies that we're putting in place and working on should dramatically improve that in 2020. So I'd say China stays similar to 2019, India dramatically improves, and then Europe, being the Czech Republic and Italy, improves, but not as dramatically as India does. Some of that also comes from the optimization of the footprint and what we're doing there and how we're doing it. So we now have an expat that's over there that's in charge of the operations. He's working very closely with our major industrial gas customers on volumes and standardization of bottles. And once we get that standardization agreed upon and certified with the majors, that drives margin as well. It also drives cost down for them, price down for them. So it's kind of a win-win, some of the activities that are underway. So big margin that should be happening in the East, and that's a couple-year process. So it'll get there part of the way this year, but it's really 2021 when you start to see the full potential in the East.
Okay, great. Thanks for that, and I'll turn it back to the queue.
Love you.
Thank you. And our next question is a follow-up question from Ben Nolan from Stifel. Your line is now open.
Hey, I appreciate you guys letting me back in. I just had a quick one. Jill, you talked about the possibility of maybe spinning the specialty business out into its own vertical maybe in 2021. Was just curious if maybe you can quantify how much revenue that would consist of, and is it all in DNS West, or is there a little bit in the cryo area or somewhere else?
Yeah, so that is the goal, and one of the things that we're in the process of doing is hiring, as I mentioned, kind of a fuller commercial team. The guys we have are just awesome at it, and we just don't have enough hands on deck. I think by the end of 2020, if that business is over $200 million in terms of heading into 2021, that would probably be the break point. Obviously, there's accounting implications and that type of thing that we have to do our homework on before we make that final determination. But that would be the tipping point for us to really move ahead with that segment. Primarily right now, it is DNS West. The goal is that it becomes in E&C cryo in particular, so some of this liquefied biogas opportunity and the renewable storage opportunity and the carbon capture are E&C activities. And that's part of this 2020 potential. But in the 2019 numbers, all specialty markets are reported in DNS West.
Okay, and you said $200 million is sort of the carve-out target. Any sense of what it was in 2019?
Yeah, so if you take out, we include over-the-road trucking right now as a specialty market. I believe that really should start going into the base because it's part of that global clean energy infrastructure build-out. So strip the over-the-road trucking out of that, you're kind of at $100 million-ish of specialty markets or so, and so doubling it.
Okay. All right. Well, that would be, especially I guess if the guide is 10% growth, that would be pretty impressive. So I appreciate you letting me follow on.
Yeah, I think there's a couple of breakthrough opportunities for our team this year that aren't in the guide, so that's probably a little bit of the contingency. And I hope the commercial team is listening to this call.
All right, I appreciate you.
Thanks.
Thank you. And our next question comes from Patrick Baumann from J.P. Morgan. Your line is now open.
Oh, hey, thanks. Good morning, Jill. Good morning, John. Appreciate the time here. Maybe just quickly on the guidance for 2020. I think you mentioned that first quarter below fourth quarter. Is that revenue and EPS or both or something else? And then just curious, phasing first half versus second half. I know there's seasonality in the business. That's why I just want to make sure I'm kind of straight on that stuff.
Yeah. First, just to answer the question, both would be both revenue and EPS was what we think ultimately is where we'll fall. So relative to where the fourth quarter is. So as far as what the profile looks like, Patrick, for the rest of the year, ultimately we feel that both revenue and EPS is going to be weighted to third and fourth quarter. That has naturally to do with the way that the business flows. If you look at our historical revenues, it tends to be stronger in the third and fourth quarter. Also, that's going to be a product of what we ultimately think is some of the big LNG orders that come in. So we think significantly weighted to the back half of the year makes sense, but still very comfortable with the overall guide.
Yep. And then what's the margin outlook embedded in the guidance for operating margins for the year?
So we had 29% gross margin, and we've got about 14.5%, 15% SG&A, so you can back into it that way. Or said differently, $200 million of SG&A.
Got it. Okay. And then any update on what you're seeing in the U.S. from a midstream perspective as it relates to that AXE business that you brought up? I think you said something about January picking up, so just curious if you could give some more color on that.
Yeah, actually, Jill gave a lot of color, Patrick, which we won't reiterate now.
Did I might have missed it. I apologize. Yeah.
Oh, that's all right. Right. So we had a good order month in January that was as strong as it's been in a year in that business. And so we're feeling like we're off to a good start relative to the fourth quarter. We're anticipating that continues, but we're staying with ultimately our overall guide of the 180 to 200 million. As you mentioned, there is some softness in overall capital spending in the gathering and processing and midstream area that we see, but we're finding our spots in terms of opportunities both in the U.S. and beyond, which we think is offsetting a lot of that. We're not going to comment only on where we think the capital spending in the U.S. is, but certainly it's something that has softened and that's been talked about widely in the public and research.
Yep. I apologize. I was hopping back and forth between calls, so I might have missed that. And then you sound pretty confident on Driftwood, so maybe you just remind us with a project of that size how that would impact your cash flow. I assume the 180 to 210 free cash flow guidance is before anything that might come from that or any other big LNG, right?
That's correct. So the only thing in the 180 to 210 is the Calcasieu Pass cash. Anything that comes in 2020 related to big LNG would be on top of that. It would depend on how many trains and phases that the projects do. So take Driftwood, to your question specifically, the first phase right now is being looked at as 16.6 million tons per annum, which the order size for us is, call it 375 to 400 million for that 16.6. We would get a portion of that of cash in the year. So if I were just roundballing it, I'd say that's 40 to 50 million of free cash flow in 2020 if that order comes by summertime.
I'm sorry, what did you say, 40 to 50, you said?
40 to 50 in 2020 if we get notice to proceed by mid-year.
By mid-year, got it. Okay, appreciate the color. Thanks a lot. Good luck.
Thanks, Patrick. Appreciate your time.
Thank you. If there are no more questions, I will turn the call back over to Jill Evanko for some concluding remarks.
Thank you. While increasing our 2020 outlook, we're also investing in our future. New specialty market commercial resources, our inaugural class of emerging leaders, the engineering fellows and key experts program, amongst other appropriate capacity and productivity-related capital. Given the strength of our backlog to support our outlook and the upside opportunity, we believe 2020 is a breakthrough year for our Chart business. Finally, thank you to all of our Chart team members for your continued efforts, which make us cooler by design. Thank you all for your time today, and goodbye.
Ladies and gentlemen, this concludes today's conference call. Thank you for participating. You may now disconnect.